welcome back to Be Rich. I have been always advocating young Indians, millennials, to invest in SIPs. I have asked them to either invest in index funds or debt market funds. Now the time has come to give a cautionary tale. I now say avoid debt market funds. Why do I say avoid debt market funds? This is because of the following reason. One, after the ILFS crisis, DHFL got into some liquidity problems. Z, Yes Bank promoters and Anil Ambani Group have defaulted on their loan commitments to mutual funds. Mutual funds were not supposed to lend to promoters, but to earn a quick buck, these mutual funds have taken security from the owners of large companies. What do I mean by security? The shareholding in the promoter quota was taken as security and money was lent against them. It got a slightly higher interest. Z Enterprises, who promoter, took that money and invested it in some infrastructure projects which did not pay off. Today, he is in no position to pay the money. The stock prices of Z have corrected enormously. He needs to sell those stocks to make good the money back to mutual funds. The security given to mutual funds have lost in value. If today they sell it, they will not even recover the principal amount. So they have unethically and immorally signed a standstill agreement with the promoter, meaning that they will not do anything till September 30th. And so the promoter of Z has time till September 30th to repay the loan by selling off his stake at a good price. Similar arrangements have been made with several companies. Well, if you have done a standstill agreement and do not show the loss that you have incurred due to the non-payment of principal and interest by promoters, then you must have declared it in your net asset value of the fund. They have acted as if the account is good for payment and NAV is calculated as usual. When some fixed maturity plans came up for payment, these mutual funds, instead of making the full payment, have released only part payments, telling their retail investors, your money is safe. When Z and other defaulters pay us, we'll pay you back. Well, this is immoral and unethical. The asset management companies should have taken the hit and paid the retail investor because they are the trustees. Their fund managers took the risk. Therefore, the retail investor should have been paid off or the NAV should have been marked down. You cannot have the cake and eat it too. That is what these guys are trying to do. So far, debt market funds have not been hit. But if this credit crisis continues for the next 6 months, debt market funds will also be hit and there will be large scale defaults. Therefore, it is my advice, if you have been regularly depositing money in debt market funds, please transfer them to a government bond fund. For if the government cannot pay money, it can anyway print money and return it to you. There is no question of default. Therefore, if you have debt exposure to corporates through mutual funds, sell them and move them to government bond funds. Those who are continuing to invest in index funds, large cap index funds, may continue to do so, and there may be volatility and the market may drop, but over a course of time will recover. So if you are investing for the long term, continue to invest in low cost index funds. Please avoid FMPs, that is fixed maturity plans. Please avoid debt funds which give to corporates. Thank you very much.